I'm 94 years old. I've been investing for 83 years. I've made $150 billion buying businesses, stocks, and real assets. And I have never owned Bitcoin, not one satoshi, not ever. People think I don't understand it, that I'm too old to get it, that I'm missing out on the future of money. That is nonsense. I understand Bitcoin perfectly. I understand the blockchain. I understand the appeal. I understand why people think it's revolutionary. And I understand exactly why it's worthless. Not risky, not speculative, worthless. As in zero. As in you're holding something that produces nothing, pays nothing, and will eventually be worth nothing. I've watched thousands of people become Bitcoin millionaires on paper. I've watched most of them lose it all trying to get richer. I've watched smart people, engineers, programmers, successful entrepreneurs throw their wealth into digital tokens that do nothing except sit in a wallet and wait for someone else to pay more. That is not investing. That is gambling. And I don't gamble with my money. I'm going to show you the 5 reasons I will never own Bitcoin. Not because I don't understand it, because I understand it too well. These are not theories. These are principles I've followed for 83 years. Principles that made me $150 billion while Bitcoin believers are still hoping to get rich. Hit the like button if you're ready to hear why the world's most successful investor thinks Bitcoin is worthless. I only share this with people who can handle arithmetic over emotion. Before we get into this, do me a favor, drop a comment right now and tell me where you're watching from. I want to know who's here. City, state, country, just let me know. Why smart people buy worthless things. Here is why smart people buy Bitcoin, even though it produces nothing. Most people think investing is about finding things that will go up in price. That is not investing. That is speculation. Investing is buying something that produces value, a business that generates profits, a property that generates rent, a bond that pays interest, something that puts money in your pocket. Bitcoin produces nothing. It generates no cash flow. It pays no dividends. It creates no products. It employs no one. It just sits there hoping someone else will pay more for it tomorrow than you paid today. That is the definition of a speculative bubble. And I don't invest in bubbles. I've watched too many smart people lose everything chasing them. You don't need to be smarter than me to avoid Bitcoin. You just need to understand the difference between an asset and a token. An asset produces value. A token just changes hands. I'll show you the 5 reasons I will never own Bitcoin. Reasons that distinguish investing from gambling. The first reason is fundamental. Let's start. Reason number 1, it produces nothing. Bitcoin produces nothing. That is the beginning and end of the analysis. A farm produces crops. A rental property produces rent. A business produces profits. A bond produces interest. A stock gives you ownership in a company that produces profits. Bitcoin produces nothing. It sits in a digital wallet. That's it. People say, but Bitcoin is scarce. So are Picasso paintings. So are baseball cards. So are Beanie Babies. Scarcity doesn't create value. Production creates value. The problem with Bitcoin is that people confuse price with value. Bitcoin has a price, but it has no value. Those are not the same thing. Value comes from production. What does the asset produce? How much cash does it generate? That's value. Price is what someone else will pay. Price can go up or down based on emotion, speculation, mania. Price is not value. I only buy things that produce value. I don't care about price in the short term. I care about what the asset produces over 10, 20, 30 years. Bitcoin produces nothing. Therefore, it has no value. Therefore, I won't own it at any price. Let me tell you about a man I know. Tech, entrepreneur, sold his company for $8 million in 2015. Smart guy. Made real money, creating real value. Then he discovered Bitcoin. It was trading at $300. He read about the blockchain, about decentralization, about how Bitcoin was going to replace the dollar. He got excited. He put $2 million into Bitcoin at $300, bought 6,667 coins. By 2017, Bitcoin hit $20,000. His $2 million became $133 million on paper. Everyone told him to sell, take the profits, diversify, buy businesses, real estate, bonds, assets that produce cash flow. He didn't sell. Why would he? Bitcoin was going to $100,000, then $1 million per coin. He was going to be a billionaire. Bitcoin crashed to $3,000 in 2018. His $133 million became $20 million, still up 10 times from his initial investment. He should have been thrilled. He wasn't, because he'd seen $133 million. He calculated what his life would be like with that money. The $20 million felt like a loss. So he held and bought more at $8,000, at $12,000, at $15,000. By 2020, he had $3.5 million invested in Bitcoin. Average cost, $5,000 per coin. Bitcoin went to $69,000 in 2021. His $3.5 million became $48 million. Again, everyone told him to sell. Again, he held. Bitcoin was going to $500,000, then $1 million. He was going to be a billionaire. Bitcoin crashed again, down to $16,000. His $48 million became $11 million. Then he needed cash for a business deal, had to sell half his Bitcoin at $22,000, locked in losses. Today, Bitcoin is around $45,000. He has about $7 million left in Bitcoin. Started with $8 million in 2015. 10 years later, he's at $7 million. He lost money in nominal terms. In real terms, accounting for inflation, he lost 30%. He could have put that $8 million in an S&P 500 index fund. At 10% per year, it would be $21 million today. Or he could have bought rental properties generating 8% annual cash flow. That would have given him $640,000 per year in income plus appreciation. Instead, he has $7 million in Bitcoin. That produces zero income, zero cash flow, just the hope that someone will pay more tomorrow. 10 years, massive volatility, incredible stress, lost sleep, lost opportunities, net result, lost money, and the worst part, he still thinks Bitcoin is going to $1 million per coin. He's learned nothing. Let me show you the math on assets that produce versus assets that don't. Asset A, Bitcoin. Buy $100,000 worth. Hold for 10 years. It produces zero cash flow. You hope it goes up in price. Best case scenario, Bitcoin 5 times. You have $500,000. You sell, pay 20% capital gains tax, net $400,000. Annual return, 14.9%. Good return, but only if you sell at the top. Worst case scenario, Bitcoin goes to zero. You have $0. Annual return minus 100%. Most likely scenario, Bitcoin goes up and down. You hold through volatility. You don't know when to sell. You probably sell at the wrong time. Average return, 0 to 5% per year. Asset B, quality dividend stock. Buy $100,000 worth of a company earning $10,000 per year, 10% earnings yield. Company grows earnings 7% per year. You reinvest dividends. Year 1, company earns $10,000, pays $4,000 dividend, 40% payout ratio. Year 10, company earns $19,672, pays $7,869 dividend. Total dividends received over 10 years, $55,219. You reinvested those dividends into more shares. Your stock position is worth $207,000, plus you collected $55,219 in dividends. Total value, $262,000. But here's the key difference. If the stock price crashes 50% tomorrow, you still own a business producing $19,672 per year in earnings. The value didn't disappear. The price temporarily disconnected from value. With Bitcoin, if the price crashes 50%, you have nothing. No earnings, no dividends, no production, just a lower price. That's why I only buy assets that produce. Production protects you from price volatility. If you own cash flow, you can wait for price to recover. If you own nothing, you're at the mercy of speculation. In 1988, I bought $1 billion of Coca-Cola stock. The company earned $1 billion per year. I paid 15 times earnings. Reasonable price. From 1988 to today, Coca-Cola has paid me over $8 billion in dividends. $8 billion in cash. In my bank account, not on paper. Real money. Plus, the stock is worth $25 billion today. Total return, $33 billion on $1 billion invested. But here's what people miss. Even if the stock price hadn't gone up at all, I still would have collected $8 billion in dividends. That's an 8 times return just from the production. The stock price appreciation was a bonus. Bitcoin can't do that. Bitcoin will never send you a dividend check. It will never produce earnings. It will never generate cash flow. Your only hope is that the price goes up. And hope is not an investment strategy. I only invest in assets that produce value. Production is the foundation of wealth. Everything else is speculation. Bitcoin produces nothing. Therefore, I will not own it, ever, at any price. But even if Bitcoin did produce something, I still wouldn't own it because of the second reason. Reason number 2, it's not backed by anything. Bitcoin is not backed by anything, not gold, not dollars, not assets, not earnings, nothing. People say the dollar isn't backed by anything either. That is ignorant. The dollar is backed by the full faith and credit of the United States government. That means it's backed by the U.S. military, the U.S. legal system, the U.S. economy, and the ability of the U.S. government to collect taxes. You might not like the dollar. You might think it's being debased, but it's backed by the most powerful economic and military force in human history. Bitcoin is backed by code and belief. When the belief goes away, the code is worthless. The problem with Bitcoin is that its value depends entirely on the next person believing it has value. That's the definition of a Ponzi scheme structure. Not a literal Ponzi scheme. There's no central operator. But the structure is the same. You only make money if someone else pays more. A business doesn't need the next buyer to believe. The business produces profits regardless of whether anyone wants to buy your shares. The profits are real, the cash flow is real, the value exists, independent of belief. Bitcoin has no independent value. It only has value if the next person believes it does. The moment people stop believing, it's worthless. Let me tell you about the tulip mania in Holland in the 1630s. This is a real story. It happened. Tulip bulbs became a speculative mania. People traded them for massive sums. One bulb sold for 10 times the annual income of a skilled craftsman. People mortgaged their homes to buy tulips. Why? Because the price kept going up, because everyone believed the next person would pay more, because it was the new thing, because if you didn't buy, you'd miss out on wealth. Then one day in February 1637, someone tried to sell and couldn't find a buyer. Panic spread. Everyone tried to sell. No one wanted to buy. The price collapsed 99% in weeks. People lost their homes, lost their savings, lost everything over tulip bulbs. Were tulips worthless? No. You could plant them and grow flowers. They had some value, but not 10 years of income value. That price was pure speculation. Bitcoin is digital tulips. The underlying technology has some value. Blockchain is interesting. Decentralization has uses. But Bitcoin at $45,000 per coin, that's not value. That's speculation. I watched the same thing happen with the dot-com bubble in 1999. Companies with no profits, no business model, no path to profitability trading at billions of dollars in market cap. Pets.com had a $300 million market cap. It sold pet food online at a loss. The company lost money on every sale, but the stock went up because everyone believed someone else would pay more. Pets.com went bankrupt in 2000. Stock went to zero. Investors lost everything. Bitcoin is Pets.com with better marketing. No, produces nothing. It's backed by nothing. It only has value if you believe someone else will pay more. When that belief ends, the value ends. Let me show you what happens when assets aren't backed by anything. Scenario 1. You buy $100,000 of stock in a company with $10,000 in annual earnings. The stock crashes 90%. Your $100,000 becomes $10,000, but the company still earns $10,000 per year. At a $10,000 market cap, that's a PE of 1. You're buying $1 of earnings for $1 absurdly cheap. You hold. The market recovers. In 5 years, the stock is back to fair value at 15 times earnings equals $150,000. You turned $100,000 into $150,000 despite a 90% crash because the earnings were still there. Scenario 2. You buy $100,000 of Bitcoin. Bitcoin crashes 90%. Your $100,000 becomes $10,000. Bitcoin produces nothing. There are no earnings, no cash flow, nothing to anchor value. The price is $10,000 simply because that's what the last trade happened at. Will it recover? Maybe. Maybe not. There's no fundamental value to return to. It's pure speculation. You're hoping belief returns. But belief is fickle. Many people who bought Bitcoin at $60,000 in 2021 sold at $20,000 in 2022. They lost 67% and panicked out. They'll never get that money back because they sold. If they bought a good business at a high price, They could have held through the crash because the earnings were still there. The business kept producing. The value didn't disappear. That's the difference between assets backed by production and assets backed by belief. During the 2008 financial crisis, I bought $5 billion of Goldman Sachs preferred stock paying 10% annual interest. Everyone thought Goldman might go bankrupt. I didn't think Goldman would go bankrupt. Goldman had a real business, real earnings, real assets, real value. The price had crashed, but the value was still there. I was right. Goldman survived. I collected $500 million per year in interest for 5 years. Then Goldman bought me out at a premium. Total profit, $3.7 billion. I made $3.7 billion because I bought a real asset backed by real production at a crisis price. If I'd bought Bitcoin in 2008, it didn't exist yet, but hypothetically, I would have been buying something backed by nothing, producing nothing, hoping belief would increase. I'll take real assets backed by real production over digital tokens backed by belief every single time. Assets must be backed by something real, earnings, cash flow, physical assets, legal claims, something that exists independent of belief. Bitcoin is backed by belief alone. When the belief fades, there's nothing underneath. That's not investing, that's praying. I don't pray with my money. I invest it in real assets backed by real production. But there's a third reason I'll never own Bitcoin, and this one is about mathematics. Reason number 3, the math doesn't work. Even if Bitcoin did produce something, it doesn't. And even if it was backed by something, it's not. I still wouldn't own it because the math doesn't work. For Bitcoin to make you rich from here, it needs to go up another 10 times, 20 times, 50 times. That means it needs to become worth more than the entire U.S. stock market. That's not going to happen. The problem with Bitcoin at $45,000 is that all the easy gains are gone. The people who bought at $100 or $1,000 made life-changing money. The people buying at $45,000 are hoping for scraps. Let's do the math. Bitcoin's market cap at $45,000 per coin is about $900 billion. For Bitcoin to 10 times from here, it needs a $9 trillion market cap. For comparison, gold's market cap is $13 trillion, and gold has been money for 5,000 years. For Bitcoin to 100 times from here, it needs a $90 trillion market cap. That's more than the entire U.S. stock market, more than the GDP of the United States. For a digital token that produces nothing, that's not investing. That's insanity. Let me tell you about a young guy I know, age 25 in 2020, software engineer making $150,000 per year. Smart kid, saved $100,000. He put it all in Bitcoin at $40,000 per coin. Everyone was talking about Bitcoin going to $500,000. Kathy Wood said $1 million per coin. Michael Saylor was buying billions. Bitcoin went to $69,000. His $100,000 became $172,500. He was thrilled. He'd made more in 6 months than he made in a year of work. He didn't sell. Why would he? Bitcoin was going to $500,000. His $172,500 was going to become $1.2 million. He was going to retire at 30. Bitcoin crashed to $16,000. His $172,500 became $40,000. In 18 months, he lost $60,000. More than he'd saved in 2 years of work. Gone. He sold at $20,000, locked in a 50% loss. $100,000 became $50,000. Because he panicked. Because he realized Bitcoin might go to zero. Because he couldn't sleep watching his savings disappear. Here's the arithmetic of his mistake. If he'd put that $100,000 in an S&P 500 index fund in 2020, it would be $180,000 today. A 13% annual return. Boring. Simple. Reliable. Instead, he gambled on Bitcoin going to $500,000. He lost $50,000. 4 years of work gone. Why? Because the math never made sense. For Bitcoin to go from $40,000 to $500,000, it needed to gain $9 trillion in market cap. Where was that $9 trillion going to come from? Who was going to buy? At what price did it become too expensive? He never asked those questions. He just saw the price going up and assumed it would keep going up forever. That's not investing. That's momentum chasing, and momentum always ends. Let me show you why the math doesn't work on Bitcoin from here. Bitcoin at $45,000 has a market cap of $900 billion. Let's say you buy $100,000 worth. For you to 10 times your money, turn $100,000 into $1 million, Bitcoin needs to go to $450,000 per coin. That's a $9 trillion market cap. Where is $9 trillion in new money going to come from? The entire crypto market is $1.7 trillion. You need 5 times the entire crypto market to flow into Bitcoin alone? Possible? Maybe. Likely? No. Compare that to buying $100,000 of a quality business earning $10,000 per year and growing earnings 15% per year. In 16 years, that business is earning $72,000 per year. At a 15 P/E ratio, your shares are worth $1.08 million. You 10 times your money through earnings growth, not price speculation. Which is more likely? A business growing earnings 15% per year for 16 years? Or Bitcoin gaining $9 trillion in market cap? I'll take the business every time. I bought Apple in 2016 at $25 per share, split adjusted. Apple was earning $9 billion per quarter. Market cap was $600 billion. P/E ratio of 16.7. I didn't buy Apple because I thought the stock would go up. I bought Apple because the company was producing $36 billion per year in profits, and the stock was reasonably priced. Apple is $175 per share today. I made 7 times my money in 8 years. Not because of speculation, because Apple's earnings grew from $36 billion per year to $100 billion per year. The stock followed the earnings. That's how you get rich. Buy production. Let earnings grow. The stock price follows. Simple, boring, reliable. Bitcoin can't do that. Bitcoin produces nothing. There are no earnings to grow. Your only hope is that the price goes up because more people buy. That's not investing. That's gambling on human behavior. The math has to work. You can't get rich buying things that are already expensive hoping they'll get more expensive. You get rich buying things that are cheap and produce value that compounds. Bitcoin at $45,000 is not cheap. The easy money has been made. From here, you're hoping for greater fools to pay higher prices. That's a dangerous game. I've never played that game. I buy value that produces more value. That's how I turned $10,000 into $150 billion. Not by gambling on price, by owning production, But there's a fourth reason I'll never own Bitcoin, and this one is about risk. Reason number 4, the risks are catastrophic. Bitcoin has risks that people don't talk about. Not volatility. Everyone knows it's volatile. I'm talking about existential risks. Risks that could send it to zero overnight. Government ban, quantum computing breaking encryption, a fatal bug in the code, a better cryptocurrency rendering it obsolete, exchange hacks, lost passwords. These aren't theoretical. They've all happened to some degree, and any one of them could destroy your wealth instantly. The problem with Bitcoin is that it has single points of failure that don't exist in traditional assets. A business can have a bad quarter and recover. A property can have a bad tenant and recover. Bitcoin can have a government ban and go to zero. In 2021, China banned Bitcoin. Overnight, Bitcoin mining in China, which was 65% of global mining, went to zero. The network survived, but the price crashed 50%. If the US, Europe, and Asia all banned Bitcoin simultaneously, it would probably go to zero. Can governments ban Bitcoin? Yes. Will they? I don't know. But the risk exists, and I don't invest in things where government action can wipe out my wealth overnight. Let me tell you about Mt. Gox. This was 2014. Mt. Gox was the largest Bitcoin exchange in the world. It handled 70% of all Bitcoin transactions. In February 2014, Mt. Gox suspended withdrawals. Then it announced that 850,000 Bitcoin had been stolen, worth $450 million at the time. The company went bankrupt. People who had Bitcoin on Mt. Gox lost everything. Not because Bitcoin went down in price, because their Bitcoin was stolen and there was no way to get it back. No FDIC insurance, no government bailout, no legal recourse, just gone. One man I read about had 1,000 Bitcoin on Mt. Gox, worth $450,000 at the time. Today, that would be worth $45 million. He lost it all because he trusted an exchange that got hacked. That risk doesn't exist with stocks. If your brokerage goes bankrupt, your stocks are still yours. They're registered in your name. SIPC insurance protects you up to $500,000. The legal system protects you. With Bitcoin, if the exchange gets hacked or goes bankrupt, you lose everything. And exchanges get hacked all the time. Mt. Gox in 2014, Bitfinex in 2016, Coincheck in 2018, Quadriga CX in 2019, FTX in 2022. FTX was run by Sam Bankman-Fried, a billionaire who everyone trusted. He stole $8 billion of customer funds. People who had Bitcoin on FTX lost everything. Some lost their life savings. That's not a Bitcoin-specific risk. That's a crypto-specific risk. And I won't take that risk with my money. Let me show you the risk-adjusted returns on Bitcoin versus traditional assets. Bitcoin, expected return 15% per year? Optimistic. Risk of total loss, 10%. Government ban, quantum computing, fatal bug, better competitor. Risk-adjusted return, 15% times 90% equals 13.5% per year. But that assumes you don't get hacked. Don't lose your password. Don't get scammed. Don't leave it on an exchange that goes bankrupt. Let's say those risks add another 5% chance of total loss per year. Real risk-adjusted return, 15% times 85% equals 12.75% per year. S&P 500 Index Fund, expected return 10% per year. Risk of total loss, 0%. Companies go bankrupt, but the index replaces them. Risk-adjusted return, 10% per year. You're taking massive additional risk for 2.75% extra return. That's not a good trade. And that's assuming Bitcoin returns 15% per year going forward, which is unlikely given the math we discussed in reason number 3. The real numbers are probably Bitcoin 5% per year expected return with 15% annual risk of total loss equals 4.25% risk-adjusted return. S&P 500, 10% per year with 0% risk of total loss equals 10% risk-adjusted return. You'd be taking more risk for less return. That's the opposite of investing. That's gambling. During the 2008 financial crisis, I bought stocks when everyone was panicking. Banks were failing. The economy was collapsing. People thought the world was ending. But I wasn't worried about total loss. The U.S. government wasn't going to let the financial system collapse. The FDIC protected deposits. The Fed provided liquidity. The legal system protected shareholders. I took risk, but it was calculated risk. I knew my downside. I knew my protections. I knew that businesses would survive and recover. With Bitcoin, there are no protections, no government backstop, no legal system to appeal to. If it goes to zero, it's gone forever. I don't take risks without protections. That's not courage. That's stupidity. Every investment has risks, but some risks are calculable and some are catastrophic. Calculable risks you can hedge, diversify, and manage. Catastrophic risks you avoid. Bitcoin has catastrophic risks. Government ban, quantum computing, fatal bugs, hacks, lost passwords, exchange failures. Any one of these can send it to zero. I don't invest in things with catastrophic risk. I've made $150 billion by avoiding catastrophic risk, not by taking it. But there's a fifth reason I'll never own Bitcoin. And this one is philosophical. Reason number 5. It violates the fundamental purpose of money. Money has 3 purposes: medium of exchange, store of value, and unit of account. Bitcoin fails at all 3. As a medium of exchange, it's too slow and expensive. As a store of value, it's too volatile. As a unit of account, nobody prices things in Bitcoin. Bitcoin is not money. It's a speculative token, masquerading as money. And I don't invest in things that pretend to be what they're not. The problem with Bitcoin as money is that it's deflationary by design. There will only ever be 21 million Bitcoin. As the economy grows, there's less Bitcoin per unit of economic activity. That means the price should go up forever. Sounds good, right? Deflationary money means your savings increase in value. Wrong. Deflationary money kills economies. It incentivizes hoarding over spending. Why buy something today if your Bitcoin will buy more tomorrow? Why invest in a business if holding Bitcoin returns more? That's why every successful economy in history has used inflationary money. Mild inflation incentivizes spending and investment. That creates economic activity, jobs, growth. Bitcoin incentivizes hoarding. That creates stagnation. That's why no country will ever adopt Bitcoin as their currency. It would destroy their economy. Let me tell you about El Salvador. In 2021, El Salvador made Bitcoin legal tender. The president, Nayib Bukele, said it would bring prosperity, attract investment, and modernize the economy. El Salvador bought 2,381 Bitcoin at an average price of $43,000. Cost, $102 million. The government used taxpayer money to gamble on Bitcoin. Bitcoin crashed to $16,000. El Salvador's Bitcoin holdings lost $64 million. The IMF warned that making Bitcoin legal tender created risks to financial stability. International credit rating agencies downgraded El Salvador's debt. Did Bitcoin bring prosperity? No. Did it attract investment? No. Did it modernize the economy? No. What it did was distract from real economic reforms, waste taxpayer money on speculation, and damage El Salvador's credibility with international institutions. Today, almost nobody in El Salvador uses Bitcoin for daily transactions. They use dollars. Because dollars are stable, widely accepted and understood, Bitcoin is volatile, complicated, and unreliable as money. El Salvador's Bitcoin experiment failed, not because they did it wrong, because Bitcoin fundamentally doesn't work as money. Let me show you why Bitcoin fails as money. Money needs to be a stable store of value. If you're a business and you need to pay employees, rent, suppliers, you need to know what your money will be worth next week. Bitcoin in 2021, $69,000. Bitcoin in 2022, $16,000 change, minus 77% in 1 year. If you'd been paid in Bitcoin in 2021 and held it until 2022, you'd have lost 77% of your purchasing power. That's not a store of value. That's a disaster. Compared to the dollar. Dollar in 2021, $1. In 2022, 93 cents, accounting for 7% inflation. Change, minus 7% in 1 year. The dollar lost purchasing power to inflation, but it lost 7%, not 77%. You could plan around 7%. You can't plan around 77%. Money needs to be a reliable medium of exchange. Bitcoin transactions cost $5 to $50 depending on network congestion. They take 10 to 60 minutes to confirm. You can't buy coffee with Bitcoin. You can't pay rent with Bitcoin. You can't use it for daily transactions. Credit cards process instantly and cost merchants 2 to 3%. Bitcoin processes slowly and costs more. Why would anyone use Bitcoin for transactions? They wouldn't. They don't. Bitcoin is speculation, not money. I don't invest in things that claim to be money. I invest in things that make money. Businesses that generate cash flow. That's real money. Dollars coming into my account. Money I can spend, invest, or give away. Coca-Cola sends me dividend checks in dollars. Those dollars are stable, liquid, universally accepted. I can use them immediately to buy anything I want. Bitcoin sends me nothing. If I owned Bitcoin and wanted to buy something, I'd have to sell it for dollars first. Pay fees, pay taxes, wait for the transaction to clear, then use the dollars to buy what I wanted. Why not just hold dollars in the first place? Or better yet, hold businesses that generate dollars. Money is a tool for facilitating exchange and storing value. It's not supposed to be an investment that makes you rich. If your money is making you rich, it's not money. It's speculation. Bitcoin wants to be money and an investment at the same time. It can't be both. Money needs to be stable. Investments are volatile. You can't have a volatile medium of exchange. It doesn't work. I hold dollars because they're money. I invest in businesses because they produce value. I don't hold Bitcoin because it's neither money nor a productive investment. It's just speculation. I learned these principles from Benjamin Graham. He taught me at Columbia in 1950. He taught me one thing that guides every investment decision I make. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Bitcoin does not promise safety of principal. It's volatile, unregulated, and has catastrophic risks. Bitcoin does not promise an adequate return based on productive value. It only promises potential returns based on price speculation. Therefore, Bitcoin is speculation, not investment. Ben Graham lived through the 1929 crash. He saw people lose everything chasing speculative bubbles. He saw smart people buy stocks at 50 times earnings because the market only goes up. He saw fortunes vanish overnight. He created a discipline of investing based on value, margin of safety, and productive assets. That discipline protected his wealth through the Depression and made him wealthy through the recovery. I followed that discipline for 83 years. It made me $150 billion. I'm not going to abandon it for Bitcoin. Let me make this simple. Here are the 5 reasons I will never own Bitcoin. 1. It produces nothing. Bitcoin generates no cash flow, pays no dividends, creates no products. It just sits there hoping someone will pay more tomorrow. That's speculation, not investment. 2. It's not backed by anything. Bitcoin has no intrinsic value, no earnings, no assets, no legal claim, just belief. When belief ends, value ends. 3. The math doesn't work. Bitcoin at $45,000 needs $9 trillion in new money to 10 times. That's not going to happen. The easy money has been made. From here, you're chasing scraps. 4. The risks are catastrophic. Government bans, quantum computing, fatal bugs, hacks, lost passwords. Any one of these can send Bitcoin to zero. I don't take catastrophic risks. 5. It violates the fundamental purpose of money. Bitcoin is too volatile to be a store of value, too slow to be a medium of exchange, and too unstable to be a unit of account. It's not money, it's speculation. These are not complicated reasons. Anyone can understand them, but most people don't want to understand them because they've already bought Bitcoin and they need to justify that decision. I don't need to justify anything. I've made $150 billion without Bitcoin. I'll continue making money without Bitcoin, and when Bitcoin goes to zero, which it probably will eventually, I'll still have my $150 billion. Here's your challenge. If you own Bitcoin, ask yourself honestly, why? Is it because you think it will go up in price? That's speculation, not investment. Is it because you think it's the future of money? It's not. It fails every test of what money should be. Is it because you don't want to miss out? That's fear, not analysis. Is it because everyone else is buying? That's the worst reason to buy anything. I'm 94 years old. I've seen every speculative bubble in the last 80 years. Tulips in the 1600s. History I studied. Stocks in 1929. Japanese real estate in 1989. Dot-coms in 1999. Housing in 2007. Now, Bitcoin. They all end the same way. The early buyers get rich. The late buyers lose everything, and everyone convinces themselves this time is different. This time is not different. Bitcoin produces nothing, is backed by nothing, has catastrophic risks, and fails as money. The only question is when it goes to zero, not if. Will it go to zero next year? Maybe not. Maybe it goes to $100,000 first on speculation. But eventually, when the belief fades, there's nothing underneath. and it will collapse like every other asset that was based on belief instead of production. I will not own something that produces nothing. I will not own something backed by nothing. I will not take catastrophic risks for speculative returns. I will not hold something that pretends to be money but isn't. The formula is simple. Buy assets that produce value. Hold them long enough for that value to compound. That is how you build lasting wealth. Bitcoin is not that. It's a speculative mania that will eventually end like all manias end, badly. Now, if you want more brutal honesty about investing, timeless principles that actually work instead of get-rich-quick schemes, subscribe to this channel. We don't promise easy. We don't promise fast. We promise truth. And the truth is that Bitcoin is speculation, not investment. Whether you listen or not is your choice.